All right, let's go ahead and get started. I see people are still joining in, so welcome, Darius. Good to see Ron's on the meeting here. Shelby, Sean, good to see you all. I guess you all can see me. So it's a pleasure. Again, my name is Mahesh Odhrani. For those that don't know me, I'm the president for Strategic Wealth Design. It is my pleasure to host today's webinar regarding Social Security strategies. So a couple of housekeeping items before we get started. There's a question box and there's a chat box. If you have any comments, if you have a question as I go through this, please type it in there. Everyone's on mute automatically. So please go ahead and put your question in the question box or a comment in the chat box, and I'll be happy to address them as we go along. So, and let's see here. Let's go ahead and get started. So, all right, talking about Social Security, exciting topic because Social Security is one of the most important components of an individual or a family's retirement strategy. Let me just get this box out of my way here. There we go. All right. So yeah, Social Security is one of the most important components of almost every American's, every family's, every individual's retirement income strategy. And the chances are that, like most of us, you're counting on Social Security to help supplement the retirement benefit you're building through your employer's retirement plan and perhaps your personal savings. So today I'd like to review some general information about Social Security. As you'll see in this presentation, it is high level. There's a lot of details that go into the background, which I'm hoping for you'll reach out to us or do for additional questions, or if you have other resources, you talk to your advisors about it as well. And each of you should have received a workbook via email. If you have not received the workbook, or maybe it ended up in your spam email, please go ahead and there's a handout section where we have the workbook and handout as well. So feel free to download it, follow along as well. If you print it out, there's a few places you can take notes on the workbook too. Along with the workbook, we are also offering there we go, it's working now. We're also offering a guide that you can access also in the handouts, but this guide will also be emailed over to you after the meeting is done in a follow-up email where you'll also have a survey as well. So just keep an eye out for that email for the guide, but feel free to click into the handout section and you can download the guide as well. So let's begin. Here's a brief agenda of what we're going to cover. We're going to talk about just an overview of Social Security system, how it works. We're going to discuss the benefits, how they're calculated. We're going to talk about taxation of Social Security benefits and some of the rules around it. And finally, I'll close the presentation with a quick discussion around Social Security reform efforts and what you may have read or heard about in the news, and answer any questions you may have. So quick facts about Social Security, that it's been in the US and the American landscape since 1935. Today, an estimated about 160 million workers, 96% of all American workers are covered by Social Security. The Social Security Administration estimates that 51% of the workforce do not have any type of private pension coverage. That used to be the case. That number used to be significantly higher, maybe 20, 30 years ago, but majority of the individuals do not have any type of private pension today. And 34% have no savings at all set aside for their retirement, which basically means that many workers today rely on Social Security to be their sole source of income in retirement. So take a moment in the workbook, if you have it open in front of you, think about how much write down how much money you think you have saved for retirement. You may know that top of your mind if you look at your accounts all the time, and include your retirement accounts through your employer, any personal savings that you have or investments that you may have. Go ahead and fill that out in the workbook as well. And as you can see from this chart, that not only do retired workers receive Social Security benefits, Social Security system also has disabled worker benefits and benefits for spouses and children of either retired or disabled workers, and also survivors of deceased workers as well. So as you'll see that only 70% of benefits paid out by Social Security are for retirees. 30% are paid out for other survivors or disabled individuals. So as we're going to focus, we can get into the weeds with all these other types of benefits, but we're primarily going to focus on retirees and what their benefits look like. And this additional chart shows you one of the issues with Social Security system that we're facing today is a ratio of covered workers to the number of beneficiaries, covered workers to beneficiaries of the Social Security system. So every Social Security beneficiary is covered by about 2.5 workers in 2020, or the way around, that for every 2.5 workers working and paying into the system, there's one beneficiary receiving benefits. So, however, when Social Security started back in 1930s, the estimated calculation was about 7-8 to 1 ratio. So 7 to 8 workers to every one retiree. And that number has been coming down, and they're estimating that number to stay at about 2 for many years to come. So this chart is evidence that reform is needed, which we'll discuss a little bit more later on what that may entail. So looking at Social Security, it was never intended to be the sole source of income during retirement. It was designed to supplement and primarily supplement pension plans, but also private savings, investments, and other sources of income. So according to Social Security Administration, the benefit from Social Security replaces, on average, about 40% of retirement income for an average worker. For some wage earners that have higher income, that percentage is going to be lower because there's a cap on Social Security taxation that we'll talk about. But for low wage earners, that percentage is higher. So, but on average, it's about 40%. So it's only supposed to be sort of a foundational and only replace about 40% of someone's income. Now, looking at how do we pay into Social Security? Now, if you receive your paycheck, you will recognize that there's certain things that are taken out of your paycheck, right? So one is federal income taxes, but the next set of taxes that are taken out of your paycheck that you may have noticed with acronyms OASDI and HI. So OASDI stands for Social Security's Old Age Survivors and Disability Insurance. That's a mouthful. And HI stands for Medicare's Hospital Insurance Program. So essentially, it's Social Security, OASDI is Social Security, and HI is for Medicare. Or combined together, those you may have seen on your taxes, it says FICA taxes. So generally between the Social Security and Medicare combined, the total tax rate between the two of them is about 15.3%. And half of that is generally paid by your employer, and half of that is paid by you as an employee. There's a maximum taxable wage base of $142,800. That only applies to Social Security. So any income over and above that is not taxed for Social Security. However, the taxes still continue on for Medicare. Now, if you're self-employed, if you're self-employed, filing a Schedule C perhaps, you're required to pay the full 15.3% Social Security tax. And unlike an IRA or savings account where your contributions are set aside specifically for your use, the Social Security payments essentially pass through a system where they're used to pay for current benefits, for current retirees. And as we'll discuss in a few minutes, it becomes important to look at your record of earnings because those are maintained by the Social Security Division, by the administration. So your employer, when they file your W-2 every year, when you file your taxes at Schedule C, all that gets reported up to the Social Security system. So they're keeping a track of all your earnings. And we'll talk about why that becomes important to make sure you actually verify your earnings that show up on your Social Security statement. So let's talk about how you qualify. I'm going to pause for a quick moment, see if there's any questions in the question box popping up. Nothing yet, so we'll move along. Perfect. See if a few more individuals join in. Joyce has joined in. Kathy was able to join in as well. Thank you, Kathy. Marie, welcome. All right. So we're talking about how do you qualify for Social Security benefits. So as you work and pay into Social Security system of the taxes, you earn something called credits. Those credits are basically used towards your Social Security benefit calculation. Individuals must earn 40 credits before qualifying for Social Security benefits, which equates to approximately 10 years of work. To earn a credit, you must earn $1,470 to earn one credit. Now, the amount of earnings needed to earn a work credit is adjusted annually. It adjusts for inflation, and you can earn up to 4 credits per year. And if your career is interrupted before you earn the required 40 credits, the credits are not lost. They're still being banked for you. You may miss some credits either unemployment, taking time off work for taking care of a child, or perhaps an elderly parent. So those credits are still being banked for you. And when you return to work, you will continue to earn more credits towards Social Security. Now, the Social Security system maintains earnings record for you, reflecting your work credits that you've had over the years with all your employers. Now, it becomes important to audit your Social Security statement for those earnings records. We have seen the administration, the Social Security Administration, make mistakes or employers make mistakes in reporting those earnings. Now, it doesn't happen as much. It's not as common today because of technology and all of the stuff is automated, but mistakes can happen as well. And I would recommend that you go onto your Social Security website, which we'll talk about in a bit as well. How do you log on? And just take a look and just glance at it. You don't need to pull out your W-2s, not necessarily. You don't need to pull those out to verify and audit if it's down to the last dollar. But if it looks approximately right, then I would say it's good to go. But if you feel something is off, then you may have to pull those records and talk to the Social Security Division to correct those. I have seen them sometimes put a 0 where there were some earnings for a year, and I've even seen them, instead of it being, for example, $50,000 of earnings, only crediting $5,000 because they missed a 0. So that could happen as well. So definitely take a look at your Social Security statement to make sure your earnings records are accurate. Now, there's also special crediting rules that apply for individuals in military, domestic work, doing farm work, or work for a church. So there's some special rules around that. So if you're involved in that space, talk to us, and we can get you more resources around it. And then certain classes of employees are also excluded from coverage. So any federal employees hired before 1984 are not covered, were excluded from Social Security. Railroad employees with more than 10 years of service are excluded. State and local governments. So for example, in Nevada here, if you're working for the state, you're generally not paying into Social Security because you have PERS benefit. And then also children under 21 who perform perhaps household chores of their parents. So individuals that know me on this call, then you know that I've got 3 kids and I do put them to work. So unfortunately, they can accumulate any Social Security credits because of that. All right. So talking about calculating the benefits. Now, the amount of Social Security benefits will depend upon 2 variables. So it's your earnings history and the age at which you decide to retire and begin receiving those benefits. Now, for most workers, the earnings history, as I mentioned, are reported automatically by your employer, but the way it's calculated is based on an average of your 35 highest years of earnings. So the earnings are also adjusted for, or are indexed for inflation to account for changes in wages over the years. If you do not have 35 years of earnings, not to worry. Social Security just still puts a 0 in those years where you have not had any earnings and averages that out. Now, as a general rule, higher income during your working years means a higher benefit, right? That's just mathematics. So delaying your benefit payments until full retirement age, we'll talk about the timing of it, but delaying the benefits as long as possible may result in a higher Social Security benefit payment. Now, just think this through. Let's say you started working when you're 20 years old. You're 65. You're looking at retiring and collecting Social Security benefits. That's almost 45 years of earning years, right? But when you were, hopefully you're in your prime earning years, when you're 60, 65, and rather than taking early retirement, maybe you just continue working for another few more years, another 5 years, and accumulate benefits at a higher rate. And then let those ones from your 20s fall off your record, because they're going to average out the highest 35 years. So again, Social Security, we'll talk about their website, has great tools. We have access to other tools as well, but they have great tools where you can just go in and run what if scenarios. So if you're in your prime earning years and you haven't maxed out your Social Security benefits yet, you may want to take a look at considering the possibility of working for a few more years, because you may be able to max out your benefits. The maximum Social Security benefit is adjusted based upon the Consumer Price Index, on CPI. The maximum benefit in 2021, it's a little over 3,100, is 3,148. Now, as I mentioned before, for lower paid workers, that the percentage of replacement will be a bit higher. For higher wage workers, that percentage would seem lower also, because if your income is over the $142,000 threshold, where you get capped off on Social Security taxes, you're not paying into Social Security taxes, but you're not also accumulating any more benefits. So from that standpoint, the percentage will seem lower as your pre-retirement income. So now, when can you receive Social Security? Now, Social Security, we'll talk about the full retirement age. Now, you can start Social Security income as early as age 62. However, if you're widowed, you can start it as early as age 60. If you're collecting your spousal benefit. But on average, we're going to talk about the full retirement age. So this is the age that you may receive the maximum benefit available to you. Now, this is the second important variable to consider, because this, in my opinion, this is where people make the most mistakes. Because the first variable was basically the income, right? The earnings record. Mistakes can happen by employers in reporting. It's rare. And that's something you don't have control over. You can get it fixed if there were some issues, but you don't have control over your past income history. This is something you do have control over today, because many times people feel like they want to take Social Security early because they feel they don't know if the system, their argument is they don't know if the system is going to be around, or if the funds are going to be available in the future. But this is the second most important variable, or second variable, but in my opinion, is the most important variable, where most people make mistakes around selecting the right age. So by law, the age when workers can receive full Social Security retirement benefits have been increasing from age 65 to 67. So as you can see, anyone born between 43 and 54, they have full retirement age of 66. And then it's been gradually increasing. And then anyone born after 1960, their full retirement age is 67. These are also printed on your Social Security statements, which you either may receive. If not, they're available online. So as I was talking about the mistakes people make with the retirement income. Now, if you start your Social Security benefits too soon, early retirement, you can start it as early as age 62. However, if you start at an early retirement of age 62, you will receive a reduced benefit. Generally, that benefit is reduced by approximately 25 to 30%. So it's 25 to 30% lower than your full retirement age, let's say 66 or 67. So the Social Security system has a calculator available on their website, which will allow you to model the different scenarios and different ages that you want to draw these benefits. There are many factors to consider this, and the reason why this, in my opinion, most of the time is a mistake, because you have other variables to consider, but because your benefits are reduced permanently. It's permanent by 25 or 30%. So if you start at age 62 and you live for the next 25 or 30 years, longevity is increasing as well. So if you end up living for the next 25 or 30 years, you're permanently taking that hit of a lower benefit. So it's important to consider the strategies around, if you are going to retire early, you can do that, but still, how do you delay the taking Social Security benefits? So variables to consider is employment status. We're going to talk about taxation a little bit as well, your health, life expectancy, and also your current financial assets, financial needs, and what you have going on. So there's a lot of different moving parts to it, but this is one of the things that this is the last thing we want to do, is touch our Social Security benefits early. But there are reasons some individuals do. So you may choose not to apply for Social Security retirement benefits until after reaching full retirement age. So you can delay. Now, for every year that you delay, so let's say full retirement age is age 67, you can delay as long as 70. So 70 is the maximum age you can delay till, and everyone has to start taking Social Security by that age. But by delaying, you're essentially getting an 8% increase in your monthly benefits, in your income, starting at age 70. For every year that you delay, it's 8%. So essentially, if you're going from 67 to 70, that could be about a 20, 25% increase in income. And rather than taking from age 62 and you delay till age 70, so from 60 to 70, that is almost a 76% increase higher. It's 76% higher benefit. So it's important to consider those factors. And again, depending upon longevity and other factors, it is always a good idea to take a hard look at this and consider delaying the benefits, because you're getting an 8% increase on your benefit amount. Also, the other benefit is, because if you do decide to end up working longer, then your remember those earnings calculations we were talking about, and those earnings from your 20s and perhaps 30s that keep falling off, and you're in your prime earning years, and you end up with higher benefit calculations, higher lifetime earnings calculation, so which may increase your overall benefit too. So that's an additional benefit. Now, if you do delay your Social Security benefits, it does not impact your eligibility for Medicare. So you're still eligible for Medicare at age 65. Take a quick pause here, see if any questions are popping up. For people that joined late, there's a questions box. Feel free to put in any questions that you have in there. And then also there's a chat feature. If you have any questions, you can feel free to put in the chat feature too. Let's see here. We do have a question. So the question is, if you're a widow and will earn more than spouse, I understand you will only get one benefit. May you claim that as early as 60, or is that only for those that will receive the deceased spouse's Social Security benefit? So widowed, and I don't know if you are remarried. So I will probably take this question offline, because I do need to ask a couple more clarification questions in here. So I'll take this question offline. I know who asked it, so I'll reach back out to you to answer your question. It gets a little technical, but we'll talk about some widowed benefits here in a bit as well. Let's see. So working while receiving benefits. Now, if you choose to continue working while you're receiving Social Security benefits, depending upon when you start your benefits, this will impact how much benefits you will receive. So if you're younger than the full retirement age, so in this case maybe 66, but somewhere between 66 and 67, and your annual earnings are less than $18,000, there is no impact to your Social Security benefits. So if you start benefits early and you're earning less than about approximately $19,000, so $18,960, there will be no impact to your benefits. However, if you earn more than that number, $18,960, your benefits will be reduced by $1 for every $2 above that limit. So that is if you are below your full retirement age. The year that you are going to reach your full retirement age, that year that income number is higher. So that income number now is a little over 50,000. And the reduction formula is slightly different too. So the reduction is it'll reduce by $1 for every $3 that you're above that limit. However, when you reach the month that you reach your full retirement age, so the month of your the birthday month of that you're reaching the full retirement age, there's no more income limits and there's no more offsets. There's no more reductions. So the reduction only takes place if you have earnings prior to full retirement age, and you're continuing to work and you continue to have earnings, and there's other things I'll talk about that's going to impact that. There's going to be a reduction of benefit, but after your full retirement age, Social Security does not reduce your benefits. And this is where Warren Buffett, as an example, is one of the wealthiest individuals in the world, and he's getting his Social Security, he's getting his full Social Security benefits while he has everything else, while he has all the wealth and all the income that he has. When calculating this income, this annual income limit, their sources of income obviously working and earning a salary is impacted by that, but also government benefits, investment earnings, capital gains, interest from perhaps bonds. Municipal bonds interest is also factored into that calculation. Pensions, other annuity incomes. So all that stuff is taken into consideration when if you do decide to take your Social Security benefits early, and will impact your benefit calculations, and you may have a reduction for it if your income is over that threshold. One of the things also is to start thinking about is what is your ideal retirement age? In the workbook, there's a spot right there, and the workbook as well. Just go and put down your ideal retirement age. What are you thinking? This could be good. Like if we decide to talk in the future, we'll go through that workbook and see what your ideal retirement age look like to you. Like for me, it's 70. I think I love what I do. I think I could continue working until I'm 70 based on the work that I do. But that's my ideal retirement age. So yours could be different. So go ahead and write that down. All right. We'll take a look at spousal benefits. They differ for spouses, and of course for widows and widowers, and also divorced spouses as well. So if you are married, each spouse is eligible for their own separate benefit based upon their earnings. Now, a spouse can select either of their own benefit based upon their earnings, or half of 50% of their spouse's benefit at full retirement age. So either their benefit or 50% of the spouse's benefit at full retirement age, whichever is greater. So the higher of the two. So if a spouse has low wages, they're entitled to their spouse's benefit if the spouse's benefit is going to be higher. So according to the new rules, no one may receive benefits based on anyone else's work history while their benefits are suspended. There used to be a strategy, we'll talk about it briefly. There used to be a strategy, they called it a loophole in the Social Security system where benefits could be filed and suspended. We'll talk through it. But the new rule is basically both spouses, if you're claiming a spousal benefit, which is based upon your spouse's, 50% of your spouse's benefit, your spouse has to be actively collecting benefits as well. So they have to be collecting benefits for you to be eligible to receive benefits. Talking about widows and widowers, so who were married at least 9 months before, let's move this out of the way here. So widows and widowers who were married at least 9 months before the death of their spouse are also entitled to Social Security retirement benefits based on the earnings history of the deceased spouse. A widower who begins receiving benefits at full retirement age is entitled to a benefit equal to the full benefit of the deceased spouse. So full benefit. So remember in the spousal case where it's 50% of the benefit, if a spouse passes away, then the higher benefit is paid to the surviving spouse. For widows and widowers, those benefits can start as early as 60. And also if the surviving spouse is caring for dependent children under the age of 16 or disabled children, they qualify for survivor benefits as well, immediately following death. So for example, if I had, let's say, a husband and wife one of them passes away at age 50, or the primary breadwinner passes away, the higher earner passes away at age 50, and they have young kids. Well, the widow or the widower will not receive any benefits till they hit 60. However, because they had young kids, they will receive dependent benefits. The dependent children will receive benefits from Social Security until the age of 16. And then once the spouse turns 60, they would qualify for the survivor benefits as early as 60. But if they start the benefits early, they will receive a reduced benefit because they're starting their benefits early. So they'll have the reduction as well. Divorced spouses. So a person who divorces after at least 10 years of marriage can retain Social Security benefits of their former spouse's earnings history. So we come across clients many times that are divorced, as long as they're not remarried, so they have to stay unmarried. But many times we come across divorcees and divorced individuals that did not know about this benefit. They just thought they may not get much from Social Security, or perhaps if their income was lower than their ex-spouse's, they thought the benefit amounts are going to be lower. So it is a nice surprise sometimes to them because they are able to receive benefits as long as they've been married for 10 years. They're at least age 62 and unmarried. They can receive benefits based upon their ex-spouse's earnings. So the ex-spouse does not need to be collecting or triggering the benefit at full retirement age. So if you remember, if you're married, both spouses need to be, if you're collecting a spousal benefit, the spouse that has all the earnings record, they have to activate their benefit before the spouse can receive the benefit. In divorce cases, it does not matter if the ex-spouse triggers the benefit or not. The other spouse can start the benefit as early as age 62. So next is looking at the filing strategies. So there are strategies for individuals. There are different strategies. Some of the things that we talked about, it depends also based upon other circumstances in your life. So as I mentioned, financial, longevity, health, different things that we have to consider. So there's three strategies that one could possibly use: filing for individuals, filing for spousal benefits, or filing for widow benefits. So all these strategies are slightly different. And we also have to take a look at those factors, the health, savings, longevity, to determine which benefits are not only going to be great for you in the short term, but also going to have the most impact for you in the long term. We've had quite a few filing strategy changes in 2015. So in 2015, the Bipartisan Budget Act of 2015 eliminated what they call these loopholes. They were unintended, and they actually fixed those loopholes because some individuals were taking advantage of that. But before 2015 Act was passed, you could do a strategy called file and suspend. So for example, let's say one spouse has reached full retirement age, and now what they do is they reach full retirement age. They would file for their benefit. Then their spouse will file for the spousal benefit, right? So the spouse is receiving benefits now as well. But then the main spouse that has the earnings record, they suspend their benefits. They suspend their benefits, and their benefits continue to grow over time. So I'm filing and I'm suspending, but now my spouse is starting to is collecting Social Security benefits. So while my benefits are growing, and then when I reach age 70, I start collecting a higher benefit because I did that. So the way they close that loophole is basically saying that now you cannot have one spouse on suspension and one spouse receiving benefits. Both have to be suspended or both have to receive benefits. The next strategy that was going around that time, which they corrected in 2015 as well, is what they call filing restricted. So this strategy would allow allow someone at full retirement age to file a restricted application of benefits based upon the spouse's work history. So it goes along the same line as the first one, but I'm filing benefits based upon my spouse's work history, but my earnings record are higher, and I continue to increase my benefit till age 70. So at full retirement age, I file for benefits under my spouse's income history, because assuming my spouse is working as well, so I collect 50% of their benefit. And then my benefit continues to increase till age 70 based upon my earnings record. And then I switch to my benefit because based upon my earnings, and I get a larger benefit starting at age 70. So again, that was cleaned out as well, and we can't do that anymore. So talking about Social Security taxation, so according to the administration, approximately 1/3 of those who receive Social Security benefits have to pay income taxes on their benefits. So when you earn up to certain levels, and the levels can be seen here based upon joint or individual filing, you will end up paying income taxes. So what does that mean? Is that if your income as a joint household is between 32 and 44,000, 50% of your benefits are taxable. And if your income is more than 44,000, then 85% of your benefit becomes taxable. So it becomes important in retirement to start taking a look at not only where your assets, it's called asset location. So where your assets located. If you have a lot of money in qualified plans like 401k and pre-tax qualified plans, that can have an impact on the taxation of your Social Security benefits, like an unintended consequence, because when you start reaching RMD age, which is a requirement of distribution at age 72, you will have to start pulling income out of your retirement accounts, out of the pre-tax buckets, IRAs, 401ks. So when that happens, and you have to start taking that income, it may create taxation on your Social Security benefits. So sort of an unintended consequence. So that has to be managed. There are strategies around that, and putting in place, if you give it enough time and you start putting the strategies in place today, it's better. Roth conversion is one of those. Basically, you convert your pre-tax money into a Roth bucket. You pay your tax consequences today, but everything else comes out tax-free, and that does not go against you. That does not ding you for the Social Security benefits becoming taxable. So just keep that in mind in terms of how you structure your investments, your retirement accounts. There could potentially be unintended consequences depending upon how much you're pulling out of your retirement accounts. So we're coming to a close here. Just a couple more slides. I'll go through a few more questions here, see what pops up in the question box. If you have a question, go ahead and throw it in there. So as I mentioned earlier, the Social Security Administration has developed online calculators that enable you to run a variety of what-if scenarios. They have a portal. You can go and see your earnings history. You can see your benefit amount calculations as well. And they have the online calculators. There were a wealth of information in there with additional documentation available. So I would highly, highly recommend that you take a look at the Social Security website as a resource. If you have never registered with the Social Security with SSA.gov website, I would recommend that you go and register your account. If you're looking at applying, so for Social Security benefits, the administration recommends that you apply at least 3 months before the date you want your benefits to begin. The reason being because they're going to ask for a lot of documentation like Social Security number, birth certificate, perhaps W-2s. If you notice any earnings that are incorrect and you need those corrected, that will take some time to get that fixed as well. So they do recommend at least 3 months in advance that you start the process. We had someone try to call Social Security Division 2 weeks ago, and she mentioned that she was on hold for about 2 hours. So they do have long hold times, and be prepared for that. So, but I believe you can make an appointment on the website as well if you have any specific questions, and you can just walk in. Walk-ins are usually take more time and have longer wait times as well. But you can make appointments to go see someone at the division. Talking about Social Security reform. So this is again it's a hot topic. It's an important component of every American's retirement, and that is why the topic of reform for Social Security system is very sensitive, and it's a pressing issue. It was hot last year during the elections, and it's even hot now as President Biden talks about new tax bills. So one of the concerns for the chart that we saw in the beginning, which is now illustrated here on a graphic slide, is basically the ratio of current workers or retired workers to the individuals that are actually paying into the system. And as you can see, the expectation is that that number is going to hover around 2 to 1. So for every one person that's retired, 2 people are paying into the system, and that's going to hover at that level for several years to come. I think this chart goes down to 2080. So 2086. So the concern is people are living longer. Not as many people are. The birth rate is lower as well. People are living longer, and because of that, not as many people are funding into the system. So it's a hot topic. It's a concern. The system has to be fixed. They did pass a bill back in 1983. They had a similar situation with Social Security back in early 1980s. They passed a bill after going through committees and 2 years of research about what the solutions are, and they passed the bill back in 1980s, but it was way at the tail end before the Social Security system was about to run out of money as well. So what we're expecting today, if you open up your Social Security statement, there's a clear disclaimer on that statement that says the Social Security Trust Fund is expected to be exhausted by 2034, 2035. So that's about 13, 14 years from now. And that fund being exhausted means basically that they do not have any more money earning interest. They've used up all the principal, and now the current workers are paying benefits. The people paying benefits are immediately going out. People putting money into the system, people paying the taxes, are immediately going out and paying benefits for the retirees. So the studies have shown that the amount of benefit may be reduced by about 1/3, so about 65, maybe 70, maybe 75%, depending on the studies that you look at. So between 65 to 75%. So the only benefits that will be paid out is about 65 to 75% of what the current benefit is today. So that is a concern. Solutions to fix it, there are a few. One is on the table is to increase the retirement age. They did that back in the 1980s, and now they're talking about increasing it from age 67 to perhaps 69 or even 70, because they increased it from 65 to 67. The other solution is the taking off that taxable wage base. So right now, the taxable wage base is at about 142,000. So the next solution on the table is, let's just take that wage base off, make it like Medicare, because people we pay Medicare taxes on unlimited amounts of income on our W-2s. So there's no maximum income for Medicare. So they're just talking about, let's make it like Medicare and take off that Social Security taxable wage limit. The other is increasing the percentage of taxes. So instead of it being 15.3% between Medicare and Social Security, is to increase the tax rate higher to offset for these expenses. I know President Biden has a proposal on the table as well for taxes. Basically, what this proposal is talking about is bringing in the Social Security taxation again for anyone over I believe it's the household income of about 400,000, maybe 500,000. But once you have income over a certain threshold, Social Security taxes kick back in. So there'll be that gap between the 142,000 and whatever income that they perhaps decide. But anyone over that income threshold now will have to start paying Social Security taxes again. So these are again on the table. We have a short window of opportunity here over the next 13 years that a reform is going to happen. We just don't know what form or fashion that's going to look like, because this is a very important benefit for Americans. So, and it's a sensitive and a pressing issue. So we'll see what happens. So as we close our discussion around Social Security, we're at the tail end here. I'll take a few questions. I'll look at the question box. There are a few concepts like you to keep in mind. So the amount of benefits you receive will depend on two variables: is your earnings history and the age you start receiving benefits. Social Security benefits may be taxable depending upon your different sources of income in retirement. And you have a lot of tools available on the Social Security website, ssa.gov. And I would highly recommend that you go and register your account if you haven't already. So I know I'm several years away, for 20, 25 years away from collecting Social Security benefits. So for me, I'm even registered for my account, even though for me it's so far out. So I would highly recommend that you take advantage of that. So I'll take questions. Before I take any look at the questions, just remember that in your workbook, there's a page on actions. So feel free to put in anything that you found valuable, anything you need to look at, write your to-dos in there, and basically sign up for SSA website, talk to your advisor, or give us a call if you'd like advice on your Social Security strategy. So, but put your action items in there as well. And thank you all for coming. I really appreciate it. I'm going to take questions here in a moment, but thank you all for coming. And please feel free to reach out to us if we can be a resource. One more housekeeping item: right after the survey, right after the meeting here, a survey will pop up on your screen. If you can take 2 minutes to complete that survey, I'd appreciate it. There will also be a survey that you'll receive in the email as well, the follow-up email with the guide. So if you do miss the survey, that'll pop up right after I end this meeting. Please take a moment to respond to the survey in the email. So with that, let me take a few questions here. Okay. Give me one moment. I'm having an issue with the question box here. Do see some questions in there. Let me see if I can make this work. Voila, there we go. All right. So can my wife receive 50% of my benefit if I'm not taking benefits now? Or can I take 50% of hers until I decide to take benefits? The answer is, Ron, thank you for asking that question. The answer is no, because right now, well, again, it depends upon your age, and remember, prior to 2015, prior to that law change, well, there's some age requirements around it, so we'll have to, without knowing your age, it's hard to give you a straight answer, but maybe we can speak offline about it. But the answer is, the way the law stands right now, both have to take benefits. So both of you have to activate your benefits. One cannot suspend their benefits or not receive the benefits. So the primary spouse or vice versa have to activate their Social Security benefits for the spousal benefit to kick in. The next is, so my spouse paid into Social Security for 20 years, but for the last 15 years has been with the state PERS. When I die, is it true she will not be entitled to my Social Security death benefits? So when there are state benefits involved, and someone has put money into Social Security as well, like your spouse has, and you have, there's an offset that takes place. So it depends upon their pension benefits, and there's a pension offset that takes place with Social Security. And I'll have to verify the rules in this case, Javier. So I'll get back to you on that. But I believe she may be eligible, but depends upon, she will be entitled, but I think the pension offset rule may impact her. So if you look at the state PERS website, there's some information about how the Social Security offsets on that as well. But also on the Social Security website, you can run these what if scenarios, and we have tools as well, so we can run those what if scenarios for you if you'd like. But let's talk offline and let's take a look. I have a couple more questions around that, so I'll take that offline. So if the divorced spouse, the next question is going back to divorced spouse, if she elects to take ex-husband's benefit, will it reduce the amount of his benefit? No. So it does not reduce. So the ex-spouse will get their own benefit. If they are remarried, their spouse, depending upon their earnings, will be eligible for 50% of the spousal benefit as well. And it will not have any impact on your benefit. Or their benefit. So Kathy, thank you. Thank you for your comment. So I'm happy to hear this was valuable. So I don't think I have any other questions here. Let's see. Yeah, I think I covered everything else. So for the individuals that I said, we'll cover this offline. We'll definitely reach out to you. You'll receive an email if you'd like to schedule a time with us. You can book an appointment as well. So just keep an eye out for that email. Thank you again, everyone, for being on this call. I really appreciate it. And thank you for the questions. Thank you for making it fun and engaging for me, because this is what I enjoy doing. And would have loved to see you all via video, but we usually turn these videos off because the call is recorded and we use it in the future for social media purposes and stuff. So the recording will go through compliance approval and we'll make it available. It'll probably take about a couple of weeks. Hopefully I didn't say anything that compliance doesn't like, but they will review the video, and once it's approved, it will go on our YouTube channel, and we'll send out an email when it's available. So with that, thank you. I know I've taken up enough time, and I've probably gotten into the Golden Knights are playing tonight. So I hope I can catch at least the second or third period here. So go Knights, and have a great evening. Take care.